The current global financial situation, bad as it is, no one seems to be able to explain in comprehensible terms what actually the problem is. All we know is there was a bubble, a bust.
Well, it is a financial crisis. A financial crisis is when the financial institutions primarily suffers or experience a huge erosion of their capital base. The capital base is supported by assets. This is the collateral, the security of the banking institutions, of the financial institutions when they give out lending, because banks and financial institutions are in the core business of lending to people. When they lend to people, they have collaterals in the form of assets. That asset valuation has gone down so much that it erodes their capital base. So we are in that situation. This came about when we traced what had happened in the last year and a half or so. It has its origin from America. When .com, at one time we had this .com boom in America prior to the year 2000. That boom went bust. The bubble busted.
Let me ask this question. There is a bubble, a boom, and there will be a bust.
Yes.
Then one would have expected contingencies in place. Is this a problem of overall policy, or merely you blame sectors like the bankers? And who is to blame?
I think people got carried away. If we look at it, even in the 97-98 crisis, the stock market, basically all over the world, went on and on like nobody's business, like there's no tomorrow. People don't realize that it will come down one day. So when the goings were very, very good, they forgot the basic fundamentals of risk management, looking at the profile of the risk that they are getting themselves into. They forgot about the basic concept of diversification in investment. They got themselves into one very specific industry like
housing or property.
Yeah. So when that ran into problem and the good going couldn't sustain for very long, it bound to come down. And when the .com boom busted in 2000, that creates economic recession in America. The government then came in with monetary policy by lowering the interest rate to such a low level that basically anybody is excited about it and wanted to get credit, number one. Number two, because the availability of cheap finance due to low interest rates, banking institutions were careless in their assessment of the potential borrowers that they want to give the lending to. So they started giving to people who are not of credit worthiness, of good credit ranking. This is what we call as subprime lending, second chance lending, lending to people who are of lower credit worthiness ranking. They use this money to buy houses, to get into credit card spending, to buy motor cars and all the rest of it. Now, these people, because they are of lower credit worthiness, there is every chance of them defaulting the loan sooner or later. It's a matter of time. That's what exactly happened in America. From September 2007, there's a lot of defaulting loans among the financial institutions. When the loans were defaulted, then certainly you can see straight away the housing prices will come down immediately because they cannot service the loan. Then the bank starts foreclosing, start selling off the houses, and it came down because there's no demand. That triggered the ripple effect of the crisis. Now that is one part.